My name is Davide Guidicelli. I'm actually heading up Bank Trade and Infrastructure Finance, which is a credit insurance offering for banking clients in the space of trade, structured trade, commodity finance and project finance. I'm based in Zurich, already 19 years with Swiss Re Group in various roles. And I'm originally from the Italian part of Switzerland, so a bit of background to me. Yeah, I think from my perspective, really, there are two main considerations for insurers, and I would say for the credit insurance community, right, which also includes brokers, broker partners. I think one is the question of to what extent will Basel IV impact the demand for distribution in general, but then also the demand for credit insurance in particular. And then the second consideration is to what extent will credit insurance as a risk transfer tool, right, to free up capital, to what extent will this tool be affected in the sense of will it be more effective, less effective? I would say that's the main considerations of insurers. And on the first one, on the demand side, obviously the impact of Basel IV will very much depend bank by bank, right? Because many banks, particularly also client banks of us, are under the advanced internal rating-based approach when setting capital charges. And the farther away you are to the more standardized capital charges of Basel IV, the bigger the impact, obviously, right? But I sense that in general, there is, capital management will become even more important, right? Active capital management, looking for distribution. I would interpret this as really more need to distribute, more need to partner up with credit insurers, which obviously is positive, right? Which is a good starting point, let's say. And I sense a little bit, obviously the Basel IV framework is very complex, right? I sense that the more credit insurers can give credit to structures, to security, and particularly on longer-term assets or asset-based lending, project finance, really facilities which are common in commodity finance, right? The more insurers can give credit towards that, the more beneficial this is for a bank, right, to credit insure, as a big picture impression I have. Mm. Now, turning to the other point, and here it becomes a bit more tricky, right? How effective will credit insurance remain as a risk transfer tool? I think the key driver is really this substitution approach. And actually the double trigger approach has been cancelled, right? It will not be available any longer as a tool. And the distribution or substitution approach really comes with substituting the probability of default and the loss given default of the underlying position with the insurers in our position. I would say on the probability of default side, still good, right? If insurers have a strong rating, so Swiss Re Corporate Solutions, for example, has a AA-, right, which helps. Right, so the PD side will benefit if you insure, for example, a double B position with a AA- insurer, that helps. The tricky point is the LGD side, the loss given default, where obviously the Basel IV framework foresees a generic 45 LGD floor for financial institutions like insurers. And that's actually, in my point, very concerning, right? Because I sense this to be quite off reality, right? Because 45% might be appropriate if a bank would lend to an insurer. But actually, when it comes to credit insurance, the bank is a policyholder of an insurance cover, right? And this is much more preferential, much more senior than a senior unsecured lending position. This is not really taken into account in this 45%. And the risk we really face is really that there is anti-selection right? That only the riskiest positions are still appealing enough to be credit insured, right? And obviously with that, the risk really is that the supply of credit insurance shrinks, right? Yeah. Because obviously also insurers strive for a balanced, diversified book of credits. So with that, I think it's probably fair to say I mean, the full value chain, right? Banks, insurers, broker partners, we are all in the same shoes, right? We want to ensure that credit insurance remains effective under Basel IV. And we are actually also really lobbying that topic in particular. We as an institution, mainly via ITFA, the International Trade and Forfeiting Association. So there is an insurance committee run by Sida Kalac, who works for us. And here it's really joint forces with bank partners, members of ITFA, to really make the case that this needs to be differentiated, right? And obviously there is the technical part of the 45% LGD floor. But there is also, in my view, a broader perspective, right? Essentially, I would say that insurance and brokers, together with banks, are part of a value chain, which is important for the real economy, right? And obviously, if this value chain gets disrupted with the Basel IV framework, this obviously would also have an impact on the real economy, right? Less lending, particularly maybe for smaller corporates. And that's actually a bit the positions we are taking, right? Engaging with regulators, in particular with the EBA. There has been a consultation paper. We have responded, we as a community. And also there has been hearings with EBA where we made that points. And it's difficult to judge in which direction this will lead. But for me, really means that we need to stay tuned in further lobbying, making the case to ensure that credit insurance continues to provide the value add to banks and to the real economy as it is today.